Thank you so much. Okay, can I just get a sense? I'd like to just understand the distribution of what kind of people you are. So I'd like to know how many of you are developers and how many of you run businesses. If you're a developer and you write code, can you raise your hand? Fantastic. And if you run a startup, can you raise your hand? And if you do something else that isn't being a developer or running a startup, can you raise your hand? Great. I'd love to find out about that third category afterwards. Fantastic. Okay, good. So I'm here because when I ran a startup, I made lots of mistakes about fundraising. And I always wished that I'd had someone who would tell me about what investors were really looking for. And I sometimes see the same thing happening with startup people in London, that they want to come and meet, and what they really want to find out is, before they make a pitch to anybody, they want to know what should they say, and what do they need to do in order to raise money successfully. And it might be tempting to think that it's kind of like a game, and that if you help them, then you're helping them cheat. But I really don't agree, because I think that it's in the interests of people who are like me at the moment, now an investor, to help people create great companies. And it's in your interest to create a company that's as good as possible so that you can attract investment. And that's why I'm telling you the 6 questions that I ask before making a decision to make an investment. I quit my job when I was 31 years old. I was working as a journalist, and I decided to do a startup because I had been writing about startups for a long time. It's not a joke to say that I was actually very bad at running the business. I did do a good piece of analysis in figuring out what would be a good market and a good opportunity, and we'll come on to that in a second. And the reason that the company was able to IPO after a few years, despite my bad management, was that it was not only in a very promising space, but in addition to that, it had almost no competitors. But when the company was ready for IPO, I got a call from my former boss, the editor of the Financial Times newspaper, and he said to me, "Tim, I've got to tell you that you are an inspiration to all your former colleagues." And I was kind of flattered by this, because I had been trying to get journalists to write about my company for the last 3 years, and nobody would write about it. And I had to survive on absolutely zero publicity and simply word-of-mouth marketing and the normal stuff that you do on the internet. And so when he said that I was an inspiration, I kind of felt a little flush of pride and happiness. And I thought, at last, I'm getting the recognition that I deserve. And he said, "Yes," he said, "we've been talking about you, and we've decided that if you can start a company and take it to IPO, then any idiot can." I think it's common that entrepreneurs attribute their success to their own charm and talent. And this is probably what the pie chart would look like if you ask them to be very frank about the sources of success. The reality, however, I think is very different. I think it's mostly luck, a bit of timing, and a tiny slice of what you did personally. So quick background on me. So I started and ran a company. I then joined a venture capital fund where I was responsible in part for investing $700 million. I spent some time running a small charitable foundation, which I and my wife set up with a chunk of our shares in the company. And for the last decade, I've been kind of gradually sucked back into the early stage internet space, making investments there. And I think if there's one thing I've learned, it's that you do lots of things wrong. And you must expect to do lots of things wrong. But your ambition has to be to not repeat the mistakes that you've made in the past. Many of you have heard of Esther Dyson, who is a very famous commentator and investor in the United States. And this is her in her office, which doesn't exactly look like a model of organization and clarity. But she puts those words, "always make new mistakes," at the bottom of her emails. And I think they're quite powerful. Anyway, enough stuff. My 6 questions consist of 4 questions about the company and 2 questions about the investor. And if it gives you some help in thinking about how to fundraise and also thinking about how to structure and run your business, then I'll be happy. What I thought I'd do is tell you the questions, give you a case study for each of the questions, and then also give you an example from companies that I have actually invested in. And you don't need to take many notes or any notes, because I'm happy to give you a handout afterwards. And I'll create a URL where you can ask me for the handout, and then I'll send it to you. And as I said, you'll tell me if I talk too fast. So the first question is kind of obvious. And I would say the important thing to understand is that you really want the perfect entrepreneur to have many different talents. One is you've got to be clearly as clever as Einstein. The second is that you have to be as organized as the best management consultant. The third is you have to be as aggressive and energetic as a paratrooper. I heard somebody once say that he often found that Israeli entrepreneurs, when he turned them down and said, "No thanks, I don't want to invest in your company," they would not stop coming. They would keep bugging him till he said yes. And one way he put it is, if you don't let them in through the door, then they'll abseil in through the windows. And to a limited extent, that's good. You don't want to go too far on that one. But it's also important to be aware that there are different circumstances for your company, and that you need different kinds of leadership in different circumstances. I don't know if you've heard of the firm Andreessen Horowitz in Silicon Valley, but Ben Horowitz, the co-founder of that venture capital firm, wrote an interesting book called The Hard Thing About Hard Things, which is about how to run startups. And he's got a chapter whose title is Peacetime CEO, Wartime CEO. And he says that the kind of things you have to do to run a company successfully when everything's going well are very different from the kinds of things you have to do when it's going badly. And therefore, there's no such thing as the best CEO. There's only the right person for the right circumstances. The bottom bullet there is, to me, the most important. That if I'm coming in as an investor, I think it's absurd to expect the team to be fully complete and to have all the talents that it needs. And I think that you, as entrepreneurs and developers, can fairly expect that somebody who's investing in you has got to help you build out the team. They can't simply grumble that the talents that are needed are not yet present. Here's an example. Somebody pitched me a few months ago a product called Empiribox, meaning combining the words empirical, meaning studying the world, and box because it's a physical box for putting things in. And the idea was a scalable teaching system for primary schools in England. They had discovered that a tiny, tiny percentage of people who teach science to kids aged 7 to 11 actually know any science. And the result is that in England, the teaching of science to young children is incredibly terrible. And they thought, okay, we'll roll out this service of experiments and things like that in a box so that someone who's a poor scientist can still deliver an okay lesson. So in principle, sounds like an interesting idea. What did the team consist of? Well, there was the business guy, there was somebody who was a teacher, there was somebody who was going to be involved with operations who would make sure that the boxes were being sent, and there was an accountant. But they didn't actually have anyone who could sell anything to schools. And to me, if you're in a business of trying to get lots of schools to buy a box, then if you can't do that, that's a problem. Here's an example of a company that I did make an investment in. It's called ArtiCheck, and it's a tool for checking the condition of works of art. You may think, why does anybody want to do that? But imagine that you're a gallery, and you either sell a painting, or you send it for repair, or you auction it, or you insure it, or you lend it to a museum. If any of those things happens, you want to be sure that it hasn't been damaged by the other person. And therefore what you do is you get a snapshot of its condition so that if it is damaged, you can blame the other person and make them fix it. And this is surprisingly widespread and big in the art industry. And I backed somebody who was not a business person at all. She was a conservator. She had deep technical knowledge of what do conservators do when they look at an old painting. And she had very broad contacts of 3,000 people in the art world. And I thought that even though she had no technical skills and no business skills, those things were very valuable. My second question is about traction. I care about what a company has achieved relative to how long it's been going and what resources it has got. The classic pitch in Silicon Valley and increasingly in London is what people disparagingly call a deck and a dream. A set of slides that says, I haven't built anything yet, but here's what I want to do. And I have to admit to being a little bit cynical about that. Because as I see it, when you want somebody to believe in the success of your startup, you want them to believe that many extremely difficult things can happen. You want them to believe almost that miracles will come true. And if you really want to make miracles sound plausible, it's good to have achieved one or two. Can I just ask, does anybody not know what, please raise your hand if you don't know what an NDA is. Okay, so an NDA is a non-disclosure agreement. And what sometimes happens is that entrepreneurs go and see an investor and say, I'd like to tell you about my business, but before I tell you, I want you to sign this piece of paper that says you promise you won't tell anyone else, and you promise you won't do it yourself and you won't back anyone else who does it. That's a big problem for investors. And the reason it's a problem is, imagine that you've seen 500 companies in the last year, and imagine that for each one of the 500, you have signed a piece of paper saying you won't copy it. Then, 2 years down the road, you see something that is slightly similar to something that you saw this year, even though you've completely forgotten about it, and then the entrepreneur comes back to you and says, you stole my idea because you backed those guys 3 years later. That is why most venture capitalists will not sign NDAs under any circumstances. I have a slightly modified position, which is I will sign an NDA if it's specifically about the content of a patent which has not yet been granted, because that's, to me, a solid reason for needing an NDA. But if you are tempted to ask an investor to sign an NDA, then you should ask yourself the following tough question. Is the reason I want the NDA because basically all I have is an idea, and that if that idea is stolen from me, then I have nothing of value? And if that's the case, then the problem is not with the NDA, the problem is with your business. So when somebody comes to pitch and they're talking about what they're doing, I want to know not what will they do if they get given a large amount of money, but what have they done already with the resources that they had. So one way of asking the question very toughly is, what can you build for nothing? And so, for example, these guys came to me with, well, I don't really want to name the companies. I won't say too much detail. But they came to me essentially with an interesting idea and a proposal that I should pay them so that they could hire a web agency to build it, and they could hire a PR agency to publicize it. And that doesn't seem very attractive to me, because if all it is picking up the phone to engage two agencies, that's something that anybody can do. And you don't really need an entrepreneur in the middle, someone claiming to be an entrepreneur at least. So for me, finding out in advance what will work in the market is incredibly important. Can I just ask, how many of you are familiar with the ideas of the lean startup? If you are, then raise your hand. So it looks like pretty much half. How many of you have heard of Steve Blank's book, 4 Steps to the Epiphany? And it looks like that's about a quarter. So just to summarize the two in 2 sentences, the old way of doing a startup was that you build your product and you hope that people will like it. And if they don't, then you build it again. The quote-unquote lean way to do a startup is that you first of all go and talk to potential customers. And you don't say, if I build this, would you like it? Because most people are kind and polite. And they will not say, no, that is the stupidest idea I've ever heard, and I will not buy it. They will say, yes, it sounds wonderful, how exciting. And the result is that you don't get any useful information. But what you do instead is you go and talk to them about what they do in their daily life. What are the problems they have? And you start by getting a definition of their problems and ranking them in order. And then you go back to them afterwards and say, if there were a solution that did this, then would you find it useful? And it's an attempt to have a staged process in order to understand before you build anything whether it matches actually the requirements that your potential customer has. It's also important when you have a business to know what will it cost you to bring in every new customer. Some people abbreviate that as CAC, or customer acquisition cost. Other people abbreviate it as CPA, cost per acquisition. And the key thing is, it seems to me frankly lazy to go and try and raise money if you're planning to do any online marketing, if you haven't spent the €100 that you can get very easily from Google to see what it costs to get people to your site from an advertisement and see what percentage of them you can convert. It may seem very amateurish, but by the way, I went to a pitching event in Cambridge last night where there was a company that has already raised nearly 200,000 euros and is now trying to raise a further 600 euros, and they have not done any testing of customer acquisition cost. And that seems to me unforgivable. Oh no, of course they can be forgiven, they just won't be invested in. What happened with Articheck was that Annika, the art conservator that I described, did the customer discovery for no money, simply by going and talking to people. She then spent 3,000 euros on a prototype and 25,000 euros on a minimum viable product, on the simplest thing that could be built that would be something she could actually sell to people. And now she's got a team of 4 people and some significant revenue traction. And that amounts to approximately, after about a year of going, she's got 9,000 euros in sales, and this is a kind of sample of some big companies that she's talking to. We'll come back to sales cycles in a minute or two. My third question that I ask startups is about the market size, and I think this is probably the area in which people who run startups who are good at sales are most lazy. Because they will often say, well, they'll say something very general, like we think that we can get 1% of all the adults in China to buy our product. Or they'll say, the entire global television advertising industry is $42 billion. But the point is, they're not selling advertising. They're selling some tool which will be used by service providers in advertising. So $42 billion is not the size of the market that they are addressing. I prefer the phrase, the acronym TAM, Total Addressable Market. An addressable market means the amount of money that is actually spent in the year on the kinds of products and services that you sell. So here's an example. When I look at companies, I do a very, very quick back-of-the-envelope guess about how big the market would be, and I do that by multiplying 4 numbers together. I say, how many customers will buy from you? This is when the business is mature and growing at only 10% a year. How much will they pay when they buy from you? And how frequently will they buy from you? And I then simply multiply those numbers together, and then if I want to get a bit fancy, then I look at the margin, and I say, what kind of profits will you make on that? So if it's a very simple SaaS business where there's going to be almost zero support, then the margins will probably be 80%. But if it's going to be a business that requires anything to do with physical shipment of product or installation of product, the margins are going to be 50 or 40%. If it's going to be anything that's very labor intensive, it'll be 30 or 20%. And what I actually do is I take all those numbers and then I take the logarithm of those numbers. And here's how it works out. As I see it, the best business in the world to own is Google, because it's a global advertising monopoly. It's got a market share of more than 80% in practically every market where it operates. And pretty much the online advertising represents still a small percentage of total advertising, and that will grow hugely over the next few years. And Google makes, a business like Google or Facebook has the ability to make at least $10 billion a year in profits. And the log of 10 billion is 10. The log of 9 billion, of 1 billion is 9. And the log of 100 million is 8, and so on. So what that means is that you can score a business from 1 to 10, which is basically about how many zeros do the earnings have. And that may seem a bit weird, but the reason I think it's important is because it is very hard to predict in advance how big a company will be. So if you produce financial projections, you say the sales will be 2.657 million euros. And why is it 657 rather than 656? Who the hell knows? I think you can't tell whether it'll be 2 million, 3 million, or 1 million. And you're very lucky if you can simply figure out the number of zeros. Here's an example. This was a company that pitched me called Open Utility. And their business was to provide a marketplace initially where people could buy energy from small organizations that would generate energy. And they then realized that wasn't going to work, so they decided to pivot so that instead they would go to the utilities, your local gas company or your local electricity company, and they would say to the utility, we have a great idea. It will be good for you to tell your customers that if they are pro-environmentalist, that maybe they would like to know that the electricity they're buying came from a wind farm or came from passive solar or something else like that. And that will help you in marketing, it will help you increase prices, and it will help you get new customers. And we'd like you to pay us a fee for every customer who uses that service. And so that seemed like a perfectly valid business to me. But if you make any reasonable assumptions about what would happen, so for example, say they have 10 million customers and each customer pays them 6 pennies, the utility pays them 6 pennies for every customer, what that actually works out at is sales of just under £500,000 per year. And that means that even if you could sell the company for 10 times what the earnings are, you've really got quite a small company. And the truth is that it's very hard to build businesses. And often it's just as hard to build a small business as it is to build a big business. And so I think in general you should choose a big one rather than choose a small one. Note, of course, that this company, if it achieves a market share of 50%, it's doing incredibly well. And it would be a huge shame to deploy all that talent and effort to get to a 50% market for the sake of a prize that's so small. This is the comparable information for the art condition checking business that I was telling you. What it shows you is that the business, although it seems to be very boring and no one's heard of it before, is actually surprisingly big. Look, there's 55,000 museums. There's 380,000 galleries. There's 23,000 auction houses and 33,000 conservators. These are all potential clients that could pay low single-figure thousands of euros per year in service fees. And so ultimately, it's actually a surprisingly big business, and there's nobody else doing it. There's one VC whose views I very much respect, who coined this memorable phrase. I think it's very true. Most people talk about the fact that most people say that the team is the most important thing. But actually, if you put some very talented people in a miserable market, it's still hard for them to achieve anything. And I think that when you do a startup, it's worth giving very serious thought to the market before you start doing any work. My fourth question for the startup is about barriers. So you invent a better mousetrap, and you hope that everyone will come and buy your mousetrap. But then, sadly, you discover that everybody else is also building new mousetraps to your design. What's gone wrong? I think it's straightforward. The legendary American investor Warren Buffett is famous for saying that he likes to invest in economic castles protected by unbridgeable moats. Just to remind you, a moat is that kind of circular river around a castle that means if you want to invade, you first have to swim and then climb. And the point there is that if you have those barriers, it gives you a chance to make much higher margins. So what counts as the perfect barrier? Well, I would say the number one perfect barrier is intellectual property. And the most extreme case in point in recent years has been the patent wars between Apple and Samsung. You remember that on the iPhone, there is that little thing where when you flick the thing up to the top, it bounces back at you. Tiny thing, but kind of pleasant and fun, and it makes it nice to use. It was that and 3 or 4 other small things that allowed Apple to collect $1 billion from Samsung, because Samsung copied it on its own phones. And the wonderful thing about that is that the judge simply gives you the money. You don't have to do anything to work for it. Here's the second best kind of barrier, regulation. If you're in an industry where the government will not allow just anybody to open a company, but has a long list of requirements before you can open one, that's very good because it makes it difficult for everybody else. I wrote a book many years ago about Richard Branson, the founder of the Virgin Group. And it's interesting that in England, he is widely thought of as a great entrepreneur and as the friend of the consumer. And yet, when you look at his businesses, which include airlines, trains, and banking, what you realize is that all of those are highly regulated industries, and that he chooses industries which are hard to get into and consequently have very poor customer service, where if the customer service you offer is okay, then you're doing much better than everybody else. A third form of barrier, which I think is very valuable, is Metcalfe's law. If you're not familiar with Metcalfe's law, can you raise your arm? Right, okay, so Robert Metcalfe invented Ethernet, or co-invented Ethernet, And he also said that the value of a network is proportional to the number of nodes on the network. What this diagram is trying to illustrate is that if there were only 2 telephones in the world, as there were when Alexander Graham Bell first said, "Mr. Watson, come here, I need you," then a phone would not be a very useful device to have in your pocket. What makes the phone useful is the number of other people who have a telephone. And so if you can build a business where your service becomes better and better because of more people are using it, that becomes a huge barrier. And that was my own experience at the company I started, QXL. Strong brand, strong execution, and first mover advantage are all, in my view, weak and not very desirable barriers. Partly because they depend not on you being not just more talented than everybody else today, but still more talented than them next year and the year after and the year after. Here's an example of a low barrier business. In the last year, I've had 4 different pitches from people offering event discovery applications. You know, the model's relatively straightforward. I like going out in the evening. I want to find a club or a concert or something to go to. Somebody can create a beautiful app that will help me find them, and then that app can go to all the clubs and say, if I bring you a customer, will you pay me 10% of the ticket value? And yes, of course, it's true, it's plausible, it is needed, but the problem is there are lots of people doing it already. And so when you go and speak to a club and say, if I bring you a customer, will you pay me 10%? They may well respond, well, no, but how about 5%? Because I have 3 other people offering to do the same thing. Another example is payment systems at music festivals. I've seen several proposals for the same thing. Another example is an application for ordering food when you're in the line at a restaurant. You know, I don't want to wait for my hamburger. There's 6 people in front of me. I want to press the button and say Big Mac and fries so that it's ready by the time I get to the front. Again, a great thing, but not something that seems to me to have any entry barriers. What I liked about the condition checking app is that imagine you have used this application to create 50 reports on works of art. Remember that you don't expect a work of art to be damaged when you send it somewhere, and therefore you're hoping that in 3 months' time when it comes back, it will be in just the same condition as it was before. And therefore that means that the reports represent a significant sunk cost. You've spent lots of hours producing those reports, and if you stay with the product, then you can use them again next time. If you switch, you can't, and that's a useful barrier. Another example of a barrier is viral marketing. When you create a report using this system, why are you creating it? So that you can send it to somebody. And the act of sending it is marketing the product. And I like that very much. The intellectual property protection is kind of obvious. It's also interesting to be in a business where it takes a long time to get the customers to commit. Because although it's very painful for you, that means it's also very painful for the people who will follow you. So I said 6 questions. The first 4 were about the company. And here's two questions which I ask myself and which I think other investors should ask themselves and you should ask when you're thinking about investors. The first is, why did this investment come to me? Some startups are actually quite organized about approaching lots of investors. And it can sometimes be the case that if you're the investor at the bottom of the list, you're seeing the company that nobody else wants to invest in. Now, I'm not at all a believer in going with the herd, in wanting to do deals because other people want to do them. But sometimes it is worth giving serious consideration to, are there people who are more expert than me, who know more about this industry, more about this technology, and more about this space, who didn't like it? And if so, I need to be very careful in doing my due diligence. I find that the best investors, the best companies that I see come either because they're run by people I already know, or because they're run by people that they know. And so I value very much personal introductions, emails from somebody that say, you should meet this guy because he's very bright and his company's very interesting. I'm usually willing to lead investments or to invest alone. I'm also willing to look at investments where somebody I think is very bright has invested before and has helped to grow the business a bit. And I'm quite happy to pay a premium to invest at a higher valuation because of the work that has been done to move it forward. I'm much less keen on the kind of deals that come in through networks of angel investors, and I'm least keen of all on companies that sit in the middle that charge the company a fee for introducing you to the investor. Because it seems to me if you're not able to find investors on Google, that's not very positive an indication of your powers of initiative. And so that means that you probably start off with a negative to begin with when I see you. So what happened with Articheck was that the founder actually came up to me after I gave a talk similar to this. And I had coffee with her 4 times over the space of a few months as she went through her customer discovery process. And I said to her at the outset, if you can achieve a few things, and I gave her a little list, then I will give you a term sheet for an investment. And I say that actually to a surprisingly large number of people. And surprisingly few of them ever actually do those things. But she did, and she came back to me 3 months later and said, okay, I've spoken to 10 clients and here's what they said. And here's what I'm planning to build and whatever. And that's why it happened. My final question of the 6 is this. At first, you may think this has nothing to do with due diligence, with the process of deciding what companies to invest in. But as I see it, I'm trying to be a value-adding investor when I buy a share in a company. I want to help and I want to make the company better. What I don't want to be is the person who offered the highest price for the shares. I don't know if you know that that economists have demonstrated that it is almost universal that when there is an auction for something that has independently verifiable value, let me just step back a second. If there's an auction for a painting, like Munch's The Scream, what is it worth? Who knows? It's just worth, if I love Munch more than Richard does, then that's fine, I'm willing to pay more for it. But what happens if it's an auction for the right to drill for oil in a particular place in the Gulf of Mexico? That's a case where the value of that right is clearly a number that you can independently verify. You can figure out how much will it cost to drill, how much profit will you get if there is oil there, and what is the percentage probability of the oil being there. If you go and ask 100 different experts what is the probability of there being oil there, and you ask them to give you a value for what they think is of the oil, you will see a normal distribution like that. What happens in an auction is that the buyer is the guy at the far right-hand side of the distribution. And yet what we know from normal distributions is that usually the opinion in the middle is the correct opinion, and the guy on the far right-hand side is usually wrong. So what that tells me is that when you're investing in startups, if you keep winning auctions, that's a very bad sign. Now, you may think as an entrepreneur, look, that's fine. I just want to give away the least proportion of my company for the largest amount of money. And that is a reasonable position. But then you have to ask the question, what kind of investor will that attract? And so if you are highly confident that you can run your business brilliantly with no help from anybody else, then you'll be completely happy to have a moron as your investor. But if you want an investor who can help you, then maybe the auction winner will not be the right one. Here's an example of an auction, Y Combinator in the United States. They are brilliantly good at training you to produce the most magnificent 6-minute presentation of your company while there are 100 people in the room who are investors. Now, I don't think that being a buyer at the Y Combinator demo day is a very promising thing to be. It's a great way of raising money at high valuations, as I say. I don't think it's a way for you of finding good investors. Of course you would expect me to say this, but I believe that you can make a significant difference to a company by helping out in different ways, and that difference should be reflected by the entrepreneur in the value. The kind of things that I spend time, I think it's not just about specific operating expertise, it's also about giving advice where it's appropriate. I don't know if you know the word, that the word mentor is actually the name of an old guy in ancient Greece who was a friend of Odysseus and who used to take him for walks and help him solve his problems. One of the other things I think that you should hope that investors can do for you is fundraising. Once you've got their money, now they're inside and they need the business to succeed, and you can make it their job to raise the next round of financing. Here's an example of an investment I made where actually on reflection, I don't think I was able to add any value. It's a life sciences business. It didn't really need any technological expertise, and it had an excellent CEO who had run much bigger businesses before. Here's a list of the stuff that I've done over the past year at Articheck, the case study that I mentioned to you before. So to sum up, those are my 6 questions. 4 about the company and 2 about the investment, about the investor. And if the effect of seeing these and hearing me talk about them is to prompt you to think a little bit about your own company or a company that you might start, and if the effect is to give you some helpful ideas about how you can make it easier for yourself to raise investment, then I'll be very happy. Thank you very much.